watching famous Dave on YouTube.
What's going on, folks? Welcome back to the Short Vol Show live. Now, I'm just going to link this. I'm going to put the link up on StockTwits so people can find us here. Just see if we can get a couple more people to come in here. And in the meantime, let's talk about GME. So I have really not had a good year so far because of being short GME and just getting crushed. So I'm not someone who is shy to admit when things aren't going well for me. That is part of the reality of being a trader. Anyhow, it is what it is. And if we look at GME now, it really seems like the price action today is looking a little bit better. I am still short this, and I have sort of a creative way using options to be short this and try to collect a little money if it doesn't go down right away. So I'm going to explain a little bit more about what I did to do that. Let's take a look at some option screens to check that out. Okay, so, and before we do that, let's just take a quick look at price action today in GME, and then I'm going to talk for a second later about UVXY as well. So here is GME price action, and that's kind of a funny looking chart, but you can see, I mean, it's zoomed out. You can see the big spike, second spike, and now we're coming off of that. The big news out today was the Chewy guy, as I put in the description, named CEO. That Chewy guy, of course, is Ryan Cohen. And this company, just to sum it up really quickly, GameStop is a company that was selling used video games and regular video games in the malls. Most people know about them from seeing them in their local malls. It became very popular because of these Wall Street bets guys, and thus it spiked. And most people think this initial spike was due to there being a lot of short interest in the stock, and then it spiked from there. It's been kind of funny seeing all these non-stock market people come on and be like, I'll explain GameStop to you. And these people obviously didn't know what short shares were like 10 minutes before they made the video, and they just read some article and then come on and show all their viewers about that. I'm a little different in that I have traded many stocks that had short squeezes. I have actively traded short squeezes, and I have traded hard to borrow stocks. I have done things like reversal conversions in the options, where we do an options trade, which allows me to basically give somebody long stock by doing a trade with them. So, for example, we could do an options trade where I sell you stock and I buy a call and sell a put against it. That way it's a package deal where you get the stock, and in exchange I get a call and a put. And the reason I would do that is because of the pricing. We price it in such a way that if I don't get bought in on the stock, I'll make money. And in the meantime, you get the long stock so that you can short shares. The hard to borrow is a interesting dynamic about how hard to borrow works. I did make a video about that at some point in the past, which I will try to link up in the screen here somewhere up there. But it's one of the shadiest and most opaque areas of the stock market world is stock borrowing and how shares get divided up. One basic rule of thumb is if you're going to be trading a stock that you need to short that may be hard to borrow, the bigger the company you go to trade with, the more likely it is that you'll be able to get shares. So, for example, if you have an account at, let's say, I don't know, Merrill Lynch, then you have a better chance of they have a better chance of finding you some shares to short than if you have an account at a very, very small brokerage that just started like 10 minutes ago. The more, think of it as a company that has tons and tons of customers. It's likely that some of their customers are going to actually be long this stock that you want to short, and they'll be able to borrow those shares from the people that are long the stock and loan them to you. And generally, like I said, the hard to borrow kind of play is very opaque. And what I mean by that is it's going to be hard. It's hard to get the information from your brokerage about how hard something is to borrow. Now, generally, the harder something is to borrow, they actually charge you interest to borrow shares to short it, right? And so the higher the interest rate you're paying is going to be indicative of how hard to borrow the stock is. However, if you just signed up yesterday with TD Ameritrade or with any of these brokerages and have $1,000 in an account, you are not going to be the priority when it comes to somebody to loan shares to, right? So if you have $10 million on account with Morgan Stanley, they're going to be able to find you shares, or they're going to go out and look for shares for you and find them for you before they're going to find shares for, us normal people that have smaller accounts. So that's kind of the way the hard to borrow thing works. So GME, for a long time, it seemed like any news that was slightly good made this thing spike to the moon, right? Today, it tried to do that, and it kind of failed, right? So we saw, if we look at the chart behind me here, we saw the announcement of Ryan Cohen made chair. We see the spike. It got up to almost 190, but it didn't even take out the highs of 2 sessions ago. And then as soon as the open came, it went straight back down. If you were to look back at my past videos about GME, you'd see in almost every single video I have said these guys are going to announce a secondary offering. So they're going to sell more shares. And indeed, GME did announce that they were going to sell some more shares. So I'm going to pull up the article on here. And it just makes sense. AMC did as well. I was saying as soon as this thing spiked, they're going to start doing the paperwork and offer more shares, because why not capitalize on the fact that the stock price is higher? In essence, once a company originally sells shares, if they don't have some other sort of mechanism that's connected to the stock market, once they sell their shares initially, it's over for them. They've made that they've collected that money to do whatever in their business they want to do with that money. But if the stock price goes higher later, it doesn't affect them unless the company is actually holding some of its own shares, or and certainly individuals that work for the company might be holding their own shares too. But in general, the stock price, it doesn't help them all that much. Now, certainly, GameStop has been an amazing story, and the publicity of the stock rising like it has attracted some good talent to the company. Certainly, it's all over the news. This has definitely helped. I'm not saying this hasn't helped GameStop to have these moves up. What I am saying is that it made sense for them to have an offering, and they did indeed announce 3 days ago. GameStop offers 3.5 million shares. Now, what we say in the stock market is when they offer shares, it dilutes the price, right? So if you've got 100 shares, and then all of a sudden there's another 100 shares, let's say you've got 1 million shares that are outstanding somewhere out there in the world. If you add another 1 million shares to that, each share is worth less in the end. And generally, every time they announce a secondary offering, stocks tend to deflate. Now, in GameStop's case, though, like so many other things with this stock, it really bucked that, and it didn't really noticeably go down that much on that announcement. However, my philosophy with this continues to be the same, and take what I'm saying with a grain of salt, because I have been a big loser in this stock. However, I continue to still believe that people are going to get tired of holding on to their shares of GameStop, regardless of where they bought them. And at some point, the musical chairs are moving less rapidly. Volatility is in, right? If we look at options prices here behind me, we can see front month 190, second month 180, third month 150 for volatility. These are these numbers on the right side of the screen. Now these are cut in half from where they were a month ago, right? So less volatility, there's less action, there's less excitement, and all of this, in my opinion, is going to ultimately mean the stock comes back to some sort of reality. Yes, it's great that they got all these new people involved, and yes, it's great that they're trying to turn things around, but they haven't actually turned anything around yet. And meanwhile, the stock valuation is still over $10 billion. So I see this cruising slowly lower. Now, just to make an extreme example here, here's Tilray. We saw Tilray. Not exactly the same story. However, Tilray was a company where the market got really excited about it at one moment, right? And it went way up. And I'm going to get out of the way here. You can see spike, Tilray spikes to 300, right? And everybody's all excited about it. But then over time, people are like, it starts to go down a little bit lower. It's not as exciting. And people kind of lose interest, right? Now, the stock has rallied back, right? It rallied back at the beginning of 2021 and got above 50 again. However, you see this slow grind down as people lose interest and move on to the next big thing. And I can certainly see that happening with GME. It's not a Tesla where they have this, this untangible factor of like a CEO that's like a visionary who is, can come up with anything at any moment. It's not. It doesn't have ideas, or it doesn't have unique ideas that are going to make it stand above all its competitors. Once again, I really can't get past the fact I use Steam to get my video games. Why would I switch to GameStop? It's already quite competitive. Steam's always running these discounted prices. I don't see how GameStop's going to come in and either make better prices, or like, I'm indifferent to like if it's a nice website design and whatnot. I'll just buy the game for whichever one is cheapest, and they're all kind of in the same price range. So I don't see how GameStop is going to be able to pull a rabbit out of their hat. Hello, Edward. Nice to see you this morning. You're going to get excited about the Coinbase direct listing. I guess I'm not sure when that's supposed to come out. Let's look at the news headlines just for a second here, and I like to look at Drudge Report, which is certainly a conservative-leaning site. However, Drudge Report is reporting that that Peter Thiel, remember Peter Thiel is a guy he's a hedge fund manager who had just amazing returns in the last year. Peter Thiel, venture capitalist, he says that China is using Bitcoin to corrode the U.S. financial system. Although I'm pro-crypto, pro-Bitcoin, maximalist person, I do wonder whether at this point Bitcoin should be thought of as a Chinese financial weapon against the U.S. Now, I don't know where he gets this from, and it doesn't make sort of a whole lot of sense to me. The whole thing about Bitcoin is it's decentralized, so I don't know how we can say that somehow China's in control of it. Nobody knows really the person who really started Bitcoin, but by definition, it's set up so that it's not centralized and no government can control it. So I think he kind of misunderstands crypto as far as I'm concerned. So GME, let's get back to GME. I want to talk about the options trades there, and I also want to talk about UVXY. Now, UVXY, they still haven't announced the split. Let's check right now. I keep going into Google and saying ProShares reverse split, and it just doesn't. Let's see, ProShares reverse split. It doesn't show up, but I keep trying every day to find exactly when the announcement's going to come, but it still hasn't come. You know, ProShares isn't even really on Twitter, so it's hard to even reach out to them. The CEO of ProShares is a guy named Michael Saphir, and either he has no idea who I am, which is the most likely scenario, or if he does know who I am, he's not going to like me because I made a bunch of videos against ProShares when they initially nerfed UVXY. So, like I said, I'm not under the illusion that most people know who I am in the world, which makes total sense. So he doesn't know who I am, but if he did, he probably wouldn't like me because I've been harsh against ProShares in the past. So GME, I did want to come up with the trades to collect some income while taking advantage of us going lower at some point. And this is my idea to do that. I bought, all right, so I bought some 14 May expiration put options that are out of the money, so lower than where we are now. Right now, GME is trading 175. So I bought some of the 150 puts. Small trade. I bought one 150 put and one 130 put in May 14. And then I sold puts at even lower strikes. Well, I sold the 130 strike in April against them. So I have a calendar spread on. Now, when you've got a calendar spread and your short option is at the 130 strike, that means kind of like the best case scenario is that we go, as close to that strike as possible by expiration. So 15 days, these 130 puts expire. If we were to kind of grind lower towards 130 over the next 15 days, then this position would work nicely. And that's kind of my expectation with GME, is that it's going to eventually start to grind lower over time as people kind of lose interest and move on to the next great thing. Now, they've pulled rabbits out of their hats as far as these spikes, but the second spike less than the first one, and if there's a third spike, I would think it would be less than the second one. But we'll have to wait and see. GME, once again, was way up on news of Ryan Cohen becoming CEO, but was unable to hold on to those gains in the pre-market, and since then we've seen it lower than where it ended yesterday after a bullish news. So looking not so healthy right now, GME, but still the valuation of the stock is really, really high now in my estimation. No word yet on the UVXY split, but it should be any minute. Yeah, I see that, Christine, I see you're saying maybe they want to delist UVXY. I don't see them delisting UVXY at all. Now, there was a different situation with TVIX. TVIX, the company that ran TVIX, delisted not only TVIX, but some other stocks, ETPs, A, and B, UVXY is making them money. They get a management fee. As long as people are buying shares of this, they get a management fee. So the more shares that are outstanding, the more they're making. And TVIX essentially delisted because the company behind them did not want to deal with the risk. And because TVIX is a 2 times leveraged product, it exploded when we had the whole COVID thing, right? Remember TVIX went all the way up to almost 1,000. Well, UVXY went up a lot less, and that's due to the fact that UVXY, that used to be a 2 times leveraged product, was brought down. It was delevered to a 1.5 times product after the so-called Volmageddon in a couple years ago. So the fact that UVXY has less leverage and did not make the extreme moves that TVIX did is going to keep it safe from being delisted, I believe. I think if they could have kept TVIX going, they would have, because it was making them money. It just had too much risk. If we do go to the ProShares website, however, we can see what kind of size UVXY is right now. This seems like a new thing. Please note, the funds are benchmarked to an index of VIX futures contracts. The funds are not benchmarked to a widely referenced CVO volatility index, commonly known as the VIX. Now, everybody should know that if they follow this channel. But if we look at this, we can see the notional value is, it says they've got $1 billion in cash, $1 billion in May futures, and $500 million in April futures. So there are a lot of people that are actually holding UVXY for one reason or another. Now, I personally think it's crazy to hold UVXY, but other people don't agree. And if they're charging a management fee for people holding this, and you don't notice the management fee that much because it just comes out of the price of the asset, and it's a very small level of decay. But if we look at this expense ratio, it says 0.95%. So let's say 1%, right? So if you've got $100, 1% is $1. If you've got $1,000, 1% is $10. If you've got $1 billion, that's 1,000 millions. You're essentially collecting a lot of money you're making a lot of money. So UVXY, the fund's making a lot of money. I don't see this as like, oh, just because they haven't announced a split yet, that is any indication that it's going to be delisted. I have, Christina, though, I've seen that speculation all over the place, but I don't see that as any indication that this is going to be delisted. I think it's going to be around for a long time. So the main idea of the calendar spread is when you have a calendar spread, it's kind of like being short a straddle, but you center the option you're short at the place where you think the stock is going to go to, right? So, and let's just talk about the risks of this calendar spread here, because it sounds great, right? If we look at the Greeks behind this, and let me get out of the way so you can see there. You can see it's right by my shoulder here. If you look at the Greeks behind this, it says short 16.96 deltas, collecting $21 a day. So it sounds great. You're collecting $20 a day, and you make $16 for every dollar this moves lower. But there has to be some sort of risk, right? Well, part of the risk is that this is what's called a long Vega trade. So, yes, for sure, the April options are decaying faster than the May options. That's for sure. However, if volatility comes way in, if these May options is trading a 180 vol, right? And if we go to the Analyze tab, we can see this position is actually making me long 16 Vega. So what that means is I lose $16 for every point that volatility goes down. So if May, and we can actually zero in on the exact option that we are long here in May. So if we look at the May 50, stay with me just 1 second here. So if we look at the May 150 put, and let me actually do this. This is what I want to do. It's showing that put is trading at about 163 vol, right? So implied volatility for that option is 163. So if volatility goes down 10 points, then we're going to lose $16 times 10 on that option, right? $160. So all of these Greeks here, you're collecting $20 a day, but that is making the assumption that volatility stays where it is. If this slowly grinds lower, volatility is probably going to come in. If this spikes again, volatility is probably going to go back up. It kind of is. It's operating different than normal stocks at this point. But yeah, the point of this trade, because the strikes are different, like if I'm buying the 150 put and selling the 130 put, then that's a difference of 20 points in between the strikes, right? So that's essentially $2,000 between the strikes. So if a best case scenario would be that we move exactly to 130, and on expiration, these 130 puts go out worthless. And meanwhile, the 150 put that we're long has a maximum value. Now, just to eyeball this, I'm short 2 of these 130 puts. They're trading, let's say 630. So that's $600. So in the next 2 weeks, so if I'm short 2 of these, that's $1,200. As long as we stay above 130, I'm going to collect $1,200 from this side of the trade. The other side of the trade, however, is decaying as well. In this side of the trade, the 150 put's worth $22 and the 130 put's worth, $14. And so these options are decaying too, but not as fast as the other one. So I would say the calendar spread is a nice trade because you're collecting money over time as opposed to just being long puts where you're paying money. And usually the best way to understand this position, and really any position, is to really look at your Greeks. We can also plot the Greeks under a risk profile here and to kind of further understand the position. So if I do that, I look pretty pale today, don't I? So if I plot, so if I pull this up, so this is showing that basically we make money if it goes down and we lose money if it goes up, right? Essentially, our delta far kind of outweighs how much we're collecting in theta every day. However, it is nice to collect a little something every day in theta. So that's kind of where we are on this. And I like this trade because it's putting money to work. However, it's not taking a lot of risk. And if nothing kind of happens, I still collect money every day. What's up, Eric? Nice to see you. Eric says, I'm selling GME call spreads on the next spike. I'm still short VXX, sometimes using short call spreads and sometimes using the bullseye. Nice, Eric. Sweet. Well, I'm glad. It's funny, and it kind of makes perfect sense. If I had just not gone off the reservation and just continued to trade my core product, that being VXX, I would have done really well, right? Because we've had a great move down in VXX. But instead, I decided I was going to be Mr. Wise Guy and go trade GME, and I got crushed. I should have just stayed in my core product being VXX, and I would have made out like a bandit. This is the move in VXX over the last 6 months behind me here, and we've seen just a nice down move. Once again, if we back this up, we're still coming off of the spike from the initialization of the COVID stuff. Gemini, GME. June 8th is your birthday, Edward, coming up. All right, so that's it for now. Edward, I bought 2,000 shares of Peter Thiel's Palantir. That worked, I suppose, so that's good. All right, thanks for watching, everybody. I will see you in the next one. I appreciate all your support. Please leave a comment, like, subscribe, all those wonderful things. Be a member, and I will see you very shortly next time on the Short Vol Show live. We're going to go unchained here and do some videos outside. I got my. Hopefully, you all are getting vaccinated as you can. I recommend everybody get vaccinated. I got my first one last week. It's important that we get as many people vaccinated as possible to get sort of towards that quote unquote herd immunity. You help out every person that gets vaccinated helps that out a little bit here. So do your part, get vaccinated, and I'll see you next time. Thanks for watching.
You're watching Famous Dave.